how do you make a strategically sound decision about which target market to spend and go after? As a business person, you don't have unlimited attention and talent. Narrow it down, narrow it down, narrow it down. Play a smaller game that you're even better at playing.
Maui Mastermind presents the Business Coach Podcast, answering your questions and providing real actionable insights for building a better, stronger, more profitable business without sacrificing your time, life, or freedom anymore.
Well, welcome to the Business Coach. I want to continue in this episode on the thought of the series of how are we able to scale our company? What are the best leverage points to take our business and not just to grow it by 10%, but over the course of 3, 5, 7, 10 years, how do we 5x it, 10x it, 20x it? And so in the last episode, we talked in there about 3 scaling leverage points. I want to do a little bit of a deep dive here. To scale, oftentimes what we need to do is to narrow the game to a smaller game. It's counterintuitive. Most business owners, when they think about growing their business, they think about it as, oh, I should go after a broader front. I should go after more markets with more products and services in more ways. And that's almost always the opposite of what the successful strategy is. It's almost always better for you to niche down, whether it's the niche of which choice of target audience or market that you focus on, which products or services you most put your best attention on. And so in this episode, I want to talk about how do you make a strategically sound decision about which target market to spend and go after. Now, there's a couple of assumptions that I'm going to have here right now. First, I'm already assuming that you've got your existing business, right? The Business Coach, we're not about someone who's about to start a company. Now, certainly if you're not yet launched your company, you'll learn a lot from this podcast, but I'm not speaking directly to that person. I'm speaking directly to you, the person who owns a successfully operating business. That business might have $500,000 in revenue, it might have $5 million in revenue, it might have $50 million in revenue. But it's already there, it's working, it's profitable, and you've done it for enough time that now you're looking for how do I grow it bigger, and most importantly, how do I make it independent of me? That's the audience that we've been narrowed down to, and we've been focusing on for over a decade in our coaching program. So that's who we're focusing in on here. So the advice I'm giving to you assumes that because you have an existing business, you have a lot of data, a lot of information from which to make some intelligent strategic choices about where to niche down. A wonderful quote that one of my business mentors said, he said, David, grow rich in your niche. And I thought that was an interesting one. I've never been a big kind of a, looking after riches or get rich fast type of person, and I'm not a rah-rah kind of guy. But I like that simple soundbite, rich in a niche, this idea that by focusing on less, we actually can do more. If the less we focus on is a better audience to focus on in this case. So I'll start with a quick story. There was a physician that we worked with that had when we started working, we had a moderately profitable surgical practice. It was a elective surgery that he practiced that he had. He's probably earning $500,000-$600,000 a year in profit around about the time we first started working with him. He was a solo surgeon in that practice. Now, over the course of the next 7 years later, he was earning 10x more profit than what he did. Actually, he was probably closer to 15x more profit than what he was at initially. And the way that he did that was getting very strategic about which type of patient base to put his marketing dollars and his focus on, his emphasis on. He created his whole practice to serve this particular niche. And when he did that, he was able to crowd out the less profitable cases, focus for him on those cases that he was really great at helping, and to make their experience such that he was able to generate a growing effect from that. And the result was a business that had 10x'd. And to do that in 7 years is pretty extraordinary, right? So how do you go about making decisions or choices like that? Let's talk about that, because I want you to, this is not something that you just kind of make an intuitive choice about. No, we're going to use a combination of two things. We're going to use a combination of your intuition, your business judgment, and the information that exists in your business. And we're going to bring these two things together, but we're not going to make it complicated, because what I know is if you're running a $2 to $20 million a year enterprise, you have access to certain analytic tools, but you probably don't have the same analytic tools that a $200 billion company has. Fair enough. We don't need that, by the way. We don't. We can make a great decision with some limited information, with some strategic rigor. And I want to go through how you do that. As you think about it, the key for us is to be thinking about the markets that we currently serve. And so the first step I'm going to ask you to do is I'm going to ask you to look at which are our current markets that you are actively currently serving. I think that's really important for you right now. For example, let's say that you are a manufacturer. You might serve a marketplace that is, small businesses. You might also serve large corporate customers. And these large corporate customers might be in industry A, industry B, right? And when we look at these customers, I want you to think about how would you break down your current markets that you currently serve. In general, what I find is it's a question that many business owners haven't consciously looked at least not in a while. What usually happens is you start off serving everybody that you can. Why? Because in the early years of your business, you had to scramble. This is the builder who does high-end homes, but also if he gets the opportunity and he has the time and space, he's going to do a lower-end home, and he's going to do a big remodel project on a home, and maybe even send his guys out to do some repair work, and right? And he might spread himself wide because early on he needs that revenue. As he grows, though, he wants to narrow that focus down. It doesn't mean that you never take business outside of what your focus is, but you don't spend your best time, your best money, your best talent on things outside of your target audience. You only spend secondary time, talent, or attention, or even tertiary, third order time, talent, or money. It's important to think about it that way. Let's do an example here. I'm going to share with you, this is a tool we use with coaching clients for years called our Most Profitable X. And let's do the example here is a professional service firms. We call them PSF Inc., professional service firms. And this service firm in our example here, they serve several different niches. In this case, we have 5 different niches that they serve. One of the niches that they serve is medical, one is education, one is engineering, one is financial services, and one is retail. Now, as we look at this here, we're going to look at what's the total revenue for each of these markets, and most importantly, what's the gross profit from each of these marketplaces. We'll come back to this in a moment. And when we look at the gross profit based on the revenue, that lets us get their gross profit margin, which is basically how much profit do we have after paying for the cost of goods sold to deliver our product or service, but before any of our below-the-line expenses are. All right, so let's come back to this for a moment here. All right. So now, for example, in the world of medical, in our example here, this professional services firm generates $1 million of their $12.5 million of revenue from that. Now, their gross profit is a 70% gross profit margin from that one. Again, we can't just look at the $700,000 of gross profit to compare that to, for example, to education, where we had $2 million of gross profit. You might say, well, David, $2 million is more than $700,000. We should focus on education. But look at the margin, though. The medical space for them is over 2.5 or 2.25 times more profitable than the space of education. That's interesting. Now, that's not true for every business, but in our example, that is true. By looking at the gross profit margin, it lets us see by breakdown that our very most profitable is medical from a profit standpoint. Our very least is actually the retail space. Then also education. Let's put that in a different color, actually. So our retail space is our least profitable. And then also education is a very low profit margin. Now, what about these other ones there that we'll call these the also-rans? You got engineering, which is quite profitable at 67% for this person. this company, and financial services still at 50% gross profit margin. It's less profitable, but still not bad. So the first place we look at is we look at our key current target audiences that we go and we work with. And we look at them and we look at what's the gross profit margin for each of those. To do that, we need to know how much revenue do we get and how much gross profit do we get. And we simply can do a quick division from there. If I have $700,000 of gross profit from $1 million of revenue, I divide my gross profit by my total revenue from that niche. That gives me that gross profit as a percent of the revenue. In this case, it was a 70% margin from that part. So I do that through, and it helps me spot where are the places that I should not put lots of attention from a profitability standpoint. Now, education, you say, well, David, they generated $6 million. That's half almost of this company's or our company's education, $12.5 million of revenue. 6 of that came from education. I can't just dump that. That's half our business. And that's true. Let's look at a couple other things here with that. But we'll factor in from a profitability standpoint, that's probably not where we want to put our best attention. And the retail side generated just $500,000 of that $12.5 million. And it was very low profit. Matter of fact, the lowest profit of anything we had. So if I think about initial decisions, probably we're going to go ahead and eliminate that retail part of the business, free up the energy to do something else better. Let's kind of keep looking on and using and building our example here as we look at these niches. Okay, I'm going to clear off my board here. All right. Now we're going to look at 3 more categories of ways to look at your business. We're going to look at dominance, scalability, and durability. What do I mean by these things? Dominance, durability, and scalability. First of all, dominance says, how dominant are you as a player in that particular market niche relative to your competitors? So the more that when you come to in that space and you're the first choice and push comes to shove, everyone wants you to be the one, you're probably a 5. If no one knows about you and you're not even an also-ran, you're one of the stragglers behind that in the space, you're a 1, right? And so what we've done is we've used this fictitious coming up with a number 1 to 5, which is, there is no scale that tells you exactly, but we can look at our past business and look at how well do we close in that place, how well do we go when we're head to head with competition, how do we stack up against the competition in the eyes and minds of that market niche. And the better we stack up, the higher our dominance score. The lower we stack up, the lower that score. And so you're going to do your best to pull a number for that. In the example that we have here, we came up with the numbers that medical we gave ourselves in terms of dominance when we're selling our professional service to that market, a 2. In education, we were dominant. We were a 4. In engineering, we were really strong, dominant, a 4. Financial services were incredible. We're a 5. In retail, we're a 3. Again, we can't make the decision just off of this, but it's another layer to have a more sophisticated understanding of our business to make a good decision with it. Remember, one of the things we talked about in the last episode of The Business Coach was that as we want to scale the company and to do it successfully, we've got to have a more nuanced, a more sophisticated view of our businesses. We can't just look at it with a big hammer. We need to know, do we need a particular type of hammer or a particular type of tool? And that means a more granular understanding. So dominance is one way to think about that. The next way to think about your business is to, in the markets that you serve, is to look at it in terms of scalability. In terms of scalability. When you think about scalability, we think, what's the future potential to grow this market niche? If this niche is exploding and there's so much opportunity there to grow it, that's probably a 5 on a scale of 1 to 5. If you've hit the ultimate threshold to scale in that part, there's, you already handle 50, 60, 70% of the business in that niche, you're not going to get it more. It's a 1. And so when we come back to our example here and we look at these different businesses, in our example here, medical has pretty good scalability. Education, so-so. Engineering, good scalability. Financial services, great scalability. Retail, so-so. So now in terms of profitability, if we think about it, retail is bad from gross profit margin. You're not dominant. it's not that scalable, the decision about what to do there becomes even more clear. So let's come back to one more category, which is the durability of that market niche. So durability says, how long will that demand likely be there? You know, if we were to serve a niche that's going to go away, like can you imagine once upon a time, 25 years ago roughly, for one of my businesses, we built a custom fax on demand. I mean, some of you who are watching this or listening to this program, you don't need a fax on demand. What is that? Well, before there were things like websites, we would allow somebody who could call up with their phone and hit through a dial menu to download one of 200-300 different choices of documents that we would use with our clients and with our target audience. We actually worked so well that we built this fax on demand system in such a way that our customers were able to license that fax on demand system from us. We spent tens of thousands of dollars back then to figure this thing out. And lo and behold, about a year and a half after that was in play, maybe 2 years after that was in play, websites started being able to do what the fax on demand system would do as well. And today, I mean, there is no faxes. I don't know anyone that uses faxes. Maybe a doctor might for confidential information, maybe some, but even that now, it's still done mostly all through secure in the internet, right? So that would be an example of a very low durability, right? The future wasn't there for it. If you think that there's going to be demand from this market space for a long period of time, that's a very high on the durability scale. If you think that that market space is not going to need this product or service that you have, that market niche of what you sell, it's very low on the durability side. All things being equal, obviously we want to work with people who are in niches that are going to have a good durability, right? We don't want to just have to redo it all. So for example, as we think about it here, again, this is our fictitious example. In the world of medical and durability, we said that was so-so durability. Education was pretty good. Engineering was pretty good. Financial services was pretty good. And the retail side was so-so. So now when we think about making decisions about what to do in our business here, it becomes much, much easier. So it's going to come back here. So you've got medical in this particular niche for this professional service company. If I serve the medical side, it's got great gross profit. It's got low dominance. It's got great scalability. And it's got so-so in terms of the durability of that business opportunity. Okay? That's interesting with that. We're going to make some decisions based on that. Then you have education, our next one here. And education is something that has a very low gross profit margin. Yes, you are dominant in that, you know, as a player. And yes, you've got really good durability, but it's got pretty darn poor scalability. I mean, the opportunity is never going to grow to become more. And so when I look at these different things, what it lets me do is it lets me see that the very best places for me to focus on are going to be for engineering, great gross profit margins, great scalability and dominance and durability on these ones here. And medical, I am still going to put some attention there, but I'm going to coast in that. I'm going to get rid of, over time, phase out education. I'm going to eliminate immediately the retail. I'm going to put my best energy on financial services and engineering. Now, why does this matter? Like, I see it all the time. Oh, I can do more, David. I can focus on more. You know, we have a client who we coach that has a business that does a bit over $100 million a year in revenue. And he's got, I think, like more than 5 different business units. Of these business units, he's got 2 that are incredible. And of these other 4 or 5 business units, they're either so-so or actually pretty poor. But he's got a lack. His biggest limiting factor is leadership talent. But he spread his best leaders over all those businesses, which is crazy. I talked with him and I coached him and I said, look, these 2 you should get rid of as quickly as you can, which means for you in his case, because they had a certain scale and they had a value, sell them, right? Find someone to buy them from you or close them down. I know you've got staff, so find a way to reuse the best staff somewhere else or to humanely do that. But you can't waste your best leader focusing on this business. It has low margins, low scalability, low dominance, and it's not necessarily a very durable business. Focus it on here, your highest profit, your highest dominant, your highest durable and scalable opportunities. That shift was really difficult to make intellectually and emotionally, but making that shift was incredibly important from a scaling, profitability, durability of the business. Now, what about this case of our example here? We had this company that had education. Education is responsible for $6 million of revenue. $6 million of revenue out of the $12.5 million. Of course, we can't just dump that right away. Why? Because we're not idiots, right? This is where the nuanced view comes. I don't want to just drop that. I want to put my best energy to grow these other areas so that it crowds out the need to keep that particular lower profit, lower future niche. In that case, for this example, was education. So I might phase that out over 6, 12, 24, 36 months. Maybe it takes me 4 or 5 years. But I'm planting the flag that it's no longer going to get our best leaders. It's no longer going to get our best technicians. It's no longer going to get our best marketing dollars. It's no longer going to get our best strategic focus. It's going to get secondary. And I'm going to grow these other areas such that eventually I don't need the education part. I'm going to take these other places that are 2 to 3 times more profitable, that have the same future or a better future for it. Now, it's really hard to grow after 4, 5, 6 niches all at once. The gold standard says let's find our very best niche to put our best energy on, or our very best 2 niches to put our best energy on, not to go after 4 niches or 7 niches. It's too hard to do that. Now, as companies grow, the way they can overcome that limitation is they have separate units or divisions that will do that. But even still there, even if I'm a large company and I've got 22 different divisions, the talent is not equal across all of them. The need for capital is not the same across all of them. And so no matter where I stand on that scaling spectrum, I want to put my best energy, my best attention on the very best opportunities that I have in terms of the market niche. So here's my coaching to you. When you leave this here, here's what I'm asking for you to do. I'm asking that you're going to now lay out what are the market niches that you currently serve in your business. Look at your historical stuff. Over the last 3 years, what are the market niches you serve? And you're going to lay them out as a column there. And then across that spreadsheet, you're going to look at what was the revenue you generated, what was the gross profit you generated, and what was the gross profit margin you generated for each of those niches. I simply take my gross profit, $700,000, divide that by my revenue in that niche, $1 million. That gives me a 70% gross profit margin, right? You've learned to do that. After I've laid that out, I put 3 more columns across my matrix there. On a scale of 1 to 5, how, from when I look at this, how dominant are we in that niche? How scalable is that niche? And how durable is that niche? And I've already described what those are. When I've got that information, which is inside of your business, it's there. Now I can put my business hat on and use some intuition based on the data plus my brain and intuition. Now I can make some smart choices. This is where oftentimes you'll go through and you'll talk with your business coach and you'll get her best take, his best take on, once you've laid it out that way. 2/3 of the battle is laying out the information in a clear way. The last third of the battle is there's going to be some legacy parts of your business. This is very common, where it's the early parts of your business that have the lowest profitability, the poorest scalability. Yes, you have good dominance there because you've got a great reputation, but they're not scalable and they're not profitable. And you have these other opportunities that are better. And this is where the fortitude as a business owner to make the decision, and why I think a business coach is so critical, to hold you accountable to that decision, that you're going to phase away from that old historic part of the business to those parts that make the most. I'm going to give one more story as an example for it. So one of the clients we started coaching over a decade ago, in his world, he started off with 2 businesses when we met him. Originally, it was one business that he had purchased from somebody else. It was a flooring company, carpeting and hardwood flooring. And then he had started a second business along with that did fireplaces and higher-end fireplace inserts for homes. and for apartment complexes that would have a kind of a nice display, or a hotel would have a nice fireplace in the lobby or foyer areas. And when we first met him, he was putting his attention across the two businesses equally. And he was growing, but he was constrained in his growth. We did effectively the same exercise. What we discovered was the flooring company had more competition, so he was lower on the dominant side. He was the dominant person on the fireplace side. People would drive for 2 or 3 hours to a showroom to have his people do it. He was dominant. In terms of scalability, the flooring company, he had a geographic footprint, a marketplace that he could only do a certain amount for, versus he was drawing from 5 times larger footprint because people were willing to travel for the fireplace business, so he had more scalability. From a gross profit standpoint, flooring had a certain gross profit number, where his fireplace was actually a little bit more profitable from a gross profit standpoint. The best part was people paid up front from his fireplace side versus paying in arrears for the flooring side for the majority of the work. So he had collections issues and other hassles. All things being equal, the flooring business was not nearly as good. His legacy business that he paid hundreds of thousands of dollars to buy this company that he then had grown to several $1,000,000 was not nearly as good as the fireplace in that part. And then about 4 or 5 years later, he had started a third business. And what he realized was he couldn't do all these businesses. It took too much attention from him. He closed his flooring company because it just didn't match up anymore. Then he kept the fireplace and this other business at work doing certain type of servicing for large apartment complexes. And over time, what he discovered was this third business was even better than the fireplace side of the business. And so he started, his best talent went over to here. He coasted with this business because it was still profitable, and he worked to rapidly grow this third one. This is how he took from where he was profitability-wise at X, and over the course of 10 years, I think he ended up with somewhere between 7 to 10 times the profit, and his working hours went down down to about a third of the original working hours. He went from 60, 65, 70 hours per week down to about 20 to 25 hours per week, and he started taking probably 4 or 5 times the amount of vacation time. Huge deal, huge deal. All about the choice of where to put your best attention. Remember this, as a business person, you don't have unlimited attention and talent. Money is easier to get. You can raise capital if you need to. The hardest part, though, is the talent and the attention. Put your best resources, your best time, talent, attention, and money on the very best opportunity, and you do that by starving it from our lowest opportunities, either eliminating them or phasing them out fairly quickly. And then the middle ground you can coast on. And eventually that middle ground becomes, relative to this other part, your new low ground, and you'll phase that stuff out. You'll sell it off or do something with it, and you'll put your best here, and this is how you 10x, 20x a business. Again, you're not going to do this overnight. If that's what you're looking for, you're watching the wrong podcast. You're listening to the wrong place. I'm talking about what are the ways that are proven to work, where a company in the $1 to $10 million range can 5, 10, 20x profitability and its value in the marketplace over the course of 5, 7, 10, 15 years. And to do that requires that you make a smart choice about which market niches you're going to serve. The kiss of death is to be serving everybody. Narrow it down, narrow it down, narrow it down. Play a smaller game that you're even better at playing. Don't be a decathlete. Be a sprinter. Be a pole vaulter. Be a long jumper. A decathlete gets to do them all, and they do them reasonably well. But relative to the other elite athletes, they're never going to be the best sprinter. They're never going to be the best miler. They're never going to be the best pole vaulter or discus thrower. But if you narrow down, you can be. And that means that you have a business that can be more profitable, more durable, and more scalable. Good luck to you.